Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Giambrone, Head of US Equities at Barrow Hanley Global Investors, to discuss why broadening market breadth should be good for active and value strategies. Mark, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. Thanks for having me.
All right, let's talk about what our backdrop as it is right now. It's been a strong start to the year, a little bit of weakness over the past couple of weeks, but do you think the market at this point has priced in a soft landing?
I do. I think the market has been rallying, and it's been rallying with the expectation that the economy is still relatively strong, which it is. The consumer is still relatively strong, and the Fed has done most of what it's going to do in terms of raising rates. So the soft landing is, I think, now the consensus outcome, and one of the reasons why the market's been rallying.
Well, part of the rally has been it's been very concentrated. Do you think that market breadth will broaden out over the remainder of the year? And if so, why is this good for active and value strategies?
Sure, I do think so. So you're correct that they have this term now, Magnificent Seven, or something like that, where really the vast majority of the market has been led by very few names. It started early in the year with the expectation that the Fed may even lower rates at some point. Inflation was slowing, and that got some of these large tech names rallying. And then in March, of course, we had the sort of liquidity crisis around the banks, and that got them pushed into a safe haven place. And that's sort of continued now with an AI expectation that is really being built into a lot of these names. So everything has gone right for the Magnificent Seven so far this year, and they've really led the market. But that's not a healthy market. A healthy market is a market that's much broader, that the average stock is doing better or at least equal to that of the broader market. And that's a place where I think we're headed now. As things become maybe a little slower in terms of economic growth, while the Fed now is keeping rates relatively high, as the market is becoming a little more uncertain, I think what you'll find is active and value, which is what we do at Barrow Hanley, we think is the appropriate way to move forward in the market and be selective about what you're choosing, but there are still ways to win in an environment like that.
So, Mark, if we look out of the AI areas of the market, or even tech in general, what other sectors or types of stocks and companies are you looking at from a value perspective?
Sure. Well, we like the energy sector quite a bit. We think that the reality of the commodity price there is it's going to be higher for longer. There are supply constraints around most of the world, including the US, and and China really hasn't even reopened yet. People are very disappointed with what's happening there. As that continues to improve, we're going to see an upward push in demand. So again, a supply constraint with an upward push in demand means the price will be higher for longer, and those names should do very well. And the industrial sector is an excellent area. It's very diverse. It's very diverse and can participate, by the way, in technology areas where they may be the nuts and bolts of things that matter. And then we really do like the consumer, maybe more selectively, but we think within consumer discretionary, those type of areas still offer a lot of value.
Well, I mean, it's interesting what you say about industrials. I mean, I really think part of the story there is the technology and digitization transformation that group is going through.
There's no question. And not only are they going through that type of transformation for themselves, they have to help others go through that transition. And so what we see is we try to find companies that have very good end markets, and very good for a value person could mean 5, 6, 7% organic growth rates. That's an excellent position to put your business into, where you can get leverage there, and then you can drop to the bottom line to have double-digit earnings type growth, nice cash flow, et cetera. And industrials across the sector, whether it's infrastructure, whether it's CapEx, whether it's housing, there are a lot of end markets that are still very strong, and industrial companies can plug into those.
Right. Let's go back to consumer discretionary for a moment here. When we know inflation is sticky, we know that the consumer is struggling, perhaps, with student loan payments coming back online. COVID savings are, kind of at the tail end of what's left there. Are there haves or have-nots within the consumer space that you would be focused on?
All the things you said are absolutely appropriate and the right way to be concerned about how to think about that. But from a rifle shot perspective, what you also need to remember is that the consumer is in a much better position today than they've been in a long time. I know savings are coming down relative to COVID, but consumer balance sheets are very good. Generally speaking, your home is your largest asset. And as we know, the equity levels in homes are very high. Most people, even though rates are rising, have a fixed rate mortgage. And so the beauty of that is it's keeping that payment relatively low. And if you look at employment specifically and employment growth rates, they're very strong. So the job market is very strong. Rates in terms of increases in employment costs are rising. And so the consumer's in a good place. Not unfortunately, inflation does have an impact on everyone. Inflation is not good for anyone. And that's why really we have to move forward now. And the Fed needs to stay diligent to help that. But the consumer is generally in a pretty good place. Clearly, could be pockets of weakness, but we think they're in a pretty good place. And from that perspective, you can look at rifle shot approaches to the market.
All right, Mark, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.